First of all, I think everything works and nothing works, right? And so the biggest thing is just be focused on organic growth. And so I do think some of the lead gen work, Smart Asset and some of the others, OE, others, I do see that working well. We've sort of went away from that. We've sort of focused Elevation Point on our digital lead gen, meaning we're generating that on a centralized basis. And we've really found great success using meta ads focused on financial and tax planning. Those seem to be a little bit more of the ultra high net worth clients that we're looking for, that are respond to that and looking for that advice. And then maybe not as much market driven, where that can be maybe a shorter life cycle of a relationship. So we've had a lot of luck in that space, and we're growing pretty well doing that.
What's the average account size that you're seeing that would come in from the lead generation service?
So it really surprised me, to be honest. I thought, when I thought about the lead gen and the average size, it was going to be it might be a couple $100,000, but we were looking at $1.8 million, $1.9 million on an average household. And look, I mean, there were some much bigger than that. There were a few smaller than that, but that was the average, and that was well over 100 households, 200 households. And so as you think about that, that's pretty substantial amount of wealth looking for advice. And so that's why I think there's such an organic growth opportunity, because there are a lot of people looking for advice, and
Right.
so why not get out there and put yourself out there? And that's what we're trying to do.
Another thing from your presentation I thought was interesting was the 26 outlook. You said it could be a blockbuster year for advisor movement. Can you talk a little bit about what you're forecasting for 2026 and why it might be a record year?
Yeah, I do think 2026 is going to be a record year, and I think you're going to be busy.
Right.
But I would just say that the first anecdotal evidence is just our pipeline, right? It's massive, and even beyond our pipeline, which is very competitive, by the way, which tells me it's not just us; it's kind of across the space that everybody's seeing this. I just think that advisors, there's more optionality, there's more freedom and flexibility. So if they're in an environment where it's either too restrictive or there's not enough tools in the toolbox to help them grow, they're just not standing for it. But I think what's so interesting that we should all keep an eye on is the size of some of these teams. Obviously, we all saw what happened last week in Atlanta with the Merrill team that left, but that's a unicorn. Congratulations to everybody on that, by the way. What a great event for the industry. But we're seeing some really big teams that are looking, right? And when those big teams, it takes them a while to sort of get the aircraft ready to move. And so across 25, we've just been seeing that all year, which tells me probably second quarter, third quarter of 26 is going to be really busy and really big.
Right. Another interesting point, you've mentioned that sometimes advisors are leaving firms thinking they're going to an independent firm and then finding they're kind of just in another captive world. Can you talk a bit about the shades of independence
Yeah.
and maybe where on the spectrum you would see a firm like Elevation Point?
Yeah, it's a great question. There's lots of flavors of independence, right? And that's not a bad thing. It's a good thing because it allows people. But I think one of the things we've seen is when some of the captive environments lost advisors, they said, "Oh, what are we going to do? We better create our own flavor of independence." But that flavor of independence maybe isn't truly independent, because it's the same compliance people that's saying no to everything, right? It's the same pay to play around asset management and what funds they can offer and can't offer. And to me, independence is allowing you to do what's best for your client, right? And having that freedom and flexibility to do that. And so I think to any advisor that's out there thinking about independence, you're on the right track, keep thinking about it, but make sure you find your right flavor. And sort of on the left is like fully supported, we're going to do everything for you, but you got to do it our way. On the right is you're fully independent, you can do everything you want. Elevation Point lies in the middle, a little towards the right side, right? Where we want to help firms build the best firm they can build their way, but we are going to help with things like compliance and operations and technology and marketing, because we think advisors are best when they spend their time on their client experience and on prospecting new clients.
And we saw the wirehouses make some changes to comp plans. I don't know if you followed them so closely, but they were mostly positive, it seemed like, especially UBS. Do you think that some of these changes were aimed at addressing competition from the independent space?
Absolutely, they were a reaction, right? I think the firm you mentioned in particular made a big decision, and it backfired on them in a big way. I think they were losing advisors left and right, and so somebody said, "Hey, you might want to rethink that." And so I think that they did. I'm not sure you can put that back in a bottle, right? Once trust is lost, it's sort of lost. But I do think it's interesting that after that happened with that particular firm, you saw, Wells Fargo, Merrill Lynch, all these other firms, nobody's making any changes, right? And I think that's a real credit to all of us in the independent space, that, it's a bit of a checkmate, right? Where we've done our job to say, if you're not going to be compensated fairly, you're going to be too restricted in the compliance environment, you're going to be forced to use certain investments that maybe you don't feel strongly about. There's other options, and so you can't be a bully anymore to those captive advisors, or they'll walk out.
Right. How much is outside capital affecting that sense of value for an advisor? It seems like the influx and the multiples that advisors are commanding in the RIA space right now makes a wirehouse advisor think, why am I going to give up 50% when my revenue is worth 6 to 8 times that if I sell it to a private equity buyer?
You're exactly right. I think every wirehouse advisor who has the confidence to leave is thinking about it. And they're thinking about it because their biggest asset in their life is their business for the most part. I'm sure that's not true for everybody, but for the vast majority. And so I say to these advisors every day, why wouldn't you have your biggest asset on your personal balance sheet instead of sitting on somebody else's balance sheet, right? Mm-hmm. And as long as you can have a partner like Elevation Point and others that are out there that can help you do the things you don't want to do, get that asset to your personal balance sheet, right? And then when it's time to monetize it, the other thing that's happened that I think has really allowed this space to really grow is, like there's minority investors like Elevation Point, right? We don't usually take majority stakes. And so we're buying 20 or 30% of their firm. They can take chips off the table, but they can remain in control, right? And so historically, you could join a platform or you could join, an aggregator, an integrator, and sell 100%. Now you've got folks like Elevation Point that are saying, hey, there's something in the middle where you can have control, you can build your firm, you can take some chips off the table, you can have a partner help you grow faster, but you're still in control. Because I think leaving those wires, they really worry about control, and that's why we built our firm.
Looking at what's happened with Focus and Hightower's new launch of this sort of more consolidated channel, do you have any concern that when you get to that next stage and you're looking for a buyer or there's an exit, that they're going to want you to have more control over the folks you've taken the minority or middle road investment in?
It's a really good question. I mean, we've been very thoughtful about our infrastructure. We give a lot of freedom and flexibility, but if you look at our CRM, you look at our data lake, you look at our trading platform, there are a few what I call infrastructure or foundational issues that every one of our partner firms has. So if down the road, if we wanted to do something, not saying we will or we won't, if we wanted to do a roll up, we could do that very easily because we've sort of built that infrastructure. But we always tell our firms all the time, we may or may not give you that optionality, but you can run your own firm forever, right? And we're okay with that because we're investing in these businesses and they're growing. And when they're growing, why do you want to sell it? I think, one of our investors who's a really successful, wealthy entrepreneur, always says to me all the time, Jim, we shouldn't sell anything unless we have something better to buy, because all we have to do is pay taxes and go find another investment, right? And so our system is maybe a little different than most in that we're trying to take a little bit longer view in how we look at that. But I do thank Focus, because I think Focus has given the playbook on how to do it, and they've done it really, really, really well. And so hats off to them, because it's really impressive how they've done it.
And I know you've mentioned before about being careful about who you take money from. You've selected carefully some partners this time. What went into that decision in choosing immigrant and then a little bit more of private side?
I think for us, it was just where we wanted to start, where we were comfortable starting. First and foremost, we wanted to build before they came. Mm-hmm. So we spent a lot of money on our platform, and it required a certain kind of investor that was a little bit more patient and understood what we're building, right? Because we're on our way to 100 billion. We're right around 10 today. And as you think about that, we had to build a lot so that we could go quickly from 10 to 100 without having to pause.
But that was Penske initially. And then
Penske was our first that came in. And then of course, Immigrant now has become our primary partner. And, with Liz and Mark Bruno and that whole team, it's not just about capital. It's more strategic than that. I mean, we partner on a lot of things together. Their family office services, their advisor services. And so it allowed us to be a bigger, stronger firm to be able to do that. But listen, I think if you think about our business today, it's not good capital and bad capital. It's good people and bad people. And I'm just really focused on taking investments from good people, because if you're going to grow as fast as we're growing and you're going to have pipeline work we're growing, you better have substantial capital partners. And so we're open to anyone. And really, as we think forward, we're in a great spot right now. But I just think about good people.
Yeah.
You're kind of always in the capital business if you're in the M&A business.
Right.
Just are.